There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Avorians, to the Saturday software strategy session and occasionally way too in-depth macroeconomic discussion. My name is Steve Vettel. Today is the 9th of July. Post 4th of July, yes, I still have all 10 fingers. We did not blow them off at the beach, but I must say it was really fantastic to be at the type of fireworks July 4th celebration that you would never see in California because everybody's afraid fireworks are going to burn the whole state down. I get it. So it was nice to see fireworks just going off everywhere till midnight. Let's move into the Forex Factory. One note before we get into last week's news. For those that didn't see on Friday, let me just jump back to the previous date. We had non-farm employment. This came as a pretty big surprise to the market. And it's basically 112,000 more than they were expecting. Okay. This actually came as a pretty decent surprise, though, because, all the talking heads out there, and there's, obviously a bazillion of them in the financial media, some talking up their book. As, many of you know, I tell many of our listeners always, clients, students, colleagues, whatever, don't listen to most of them because they're talking their book, meaning they have some sort of agenda with the holdings that they have, and they're typically doing the opposite of what they say on TV. So try to stay away from paying attention to all but a few. And you can see some of the ones that I've retweeted on Twitter. You can follow me at FXES Trader if you want to find out more about that. But I think the key really is with this particular story, it changes the dichotomy. I still think 3/4 of a point to a half point is baked into the next couple of months by the Federal Reserve. But the more statistically the market continues to sink in equity land, surprisingly enough, we've had a hell of a rally in bond land recently. It doesn't really, it puts the Fed in a tenuous position in terms of what they can and have the ability to do. Raise rates too much, very simply, macroeconomics. I'm not going to get too much into it today, but you raise rates too much, obviously it squelches any type of investment, right? So capital investment in any form is based on low rates, right? The lower the rates, the cheaper it is to invest, the cheaper the capital is to lend, to build a factory or an auto plant, or, trickles all the way down to the common man. So that was of interest. So we move forward into the news. And I just want to say for everybody here at Auvoria, we express our condolences for the assassination of Abe. He's actually a pretty good guy, even though I disagree a bunch with his politics. He's actually done a lot for the country, so recognize his efforts. And then there's upper house elections in Japan. I think the surprising thing about all this is that, yes, the dollar did rip, and but nothing really happened to the yen. I mean, obviously, I think the damage has already been done to the currency from, just really very poor policy, which is really the Bank of Japan's fault, not necessarily Prime Minister Abe. So, any case, it's a sad situation. So, I wish him rest in peace. But going forward, we have Bank of England, Bailey speaking. This is a pretty big deal. Everybody knows that the cable has been in the toilet in relation to almost every other major out there, maybe with the exception of the euro. And then we have more discussion here on Tuesday from central bank here in the down under area. And then we've got on Wednesday, Bank of China, Bank of Canada, Bank of Canada rate policy statement, press conference, so forth. Obviously, this is going to be a brutal time in the morning of Wednesday to be trading anything related to Canadian dollar. So just be aware of that. It would not be live. I would be Memorex on those trades. So French bank holiday is on Thursday. I think this probably will take a little bit more interest in terms of US-based news stories. There is the core CPI coming out on Wednesday morning. Remember, these times are all East Coast, so always adjust these times to what your particular time zone is, so you know when these news stories could or could not affect your trading. Anything that is red folder based, I would totally stay away from. So that's it on the news front land. Let's go into my favorite. Looking at charts from a large perspective, you see here the euro. It was actually showing my wife actually, let me go back to that. So I think that's important. So if you go look at the euro, just go to a monthly chart. This is finviz.com. If you're not familiar with this is one of the best dashboards in all of the financial media stuff available on the internet in terms of big picture, looking at it all together as a comparison. I like to do this because you could see much further out. You're not necessarily looking for any particular patterns but this particular chart, which is a monthly euro. And I wanted to see the last time that this current price, which is damn near parity, was the case. Look all the way back to just before 2003. I don't know if you could see my crosshairs here on the left, but it's been a long time. So for those of you who want to travel to Europe, provided you adhere to all their crazy ass COVID protocols, probably be a more affordable vacation for you. I could be wrong because energy prices have risen everything, right? So maybe it staves off at some point. But I'll tell you, if this actually goes under $1, man, we're back to doing chart patterns to, way back when. And honestly, you can throw the vast majority of these movements out the window, right? Because everything that I'm showing back towards the beginning of essentially the changeover into Y2K, nobody's holding these positions anymore, right? So why does price action or price structure have to act anything like it did way back when? Doesn't mean crap, in my opinion. Now, sure, since this is the low of like ever, right? That would obviously carry some serious weight. There'd probably be a rip into that to see how the auctioning process works, and then probably a significant bounce from that level, right? But it's usually where it took off into a higher movement, which essentially is right here at this 0.96, which probably would have been thought to be generally unheard of at the beginning of the year. But this just goes to show you how a currency of a country that, I should say, a currency of an entire eurozone that is a good representation of the bazillion countries has had such a deflationary effect. And obviously there's central bank movements that are to blame for this. There is obviously the war in Ukraine. There's just, I don't know, it just seems to me, if I was a big hedge fund, had lots of long-term potential holdings to load up on, that if we get down near parity, it almost seems like this would be a pretty decent hold for a trade going forward. Now, obviously it's tough catching a falling knife, and that's an analogy I'm using that probably doesn't apply to anybody that's a trader listening to this cast, right? But you always want to be thinking about like good long-term holdings, right? So I mean, even though the ashes may be terrible of any kind of wreck, right? Wouldn't you like to own Berkshire Hathaway at half its current price, or Nvidia at half its current price, right? I should say half of the price it was at. So even though it's difficult, and all the charting books and all the gurus out there, including myself, the important thing to understand is I choose to sift through ashes and asset purchases, and regardless of what it is, that's just the best place to be buying, right? But it'll never feel right. It'll always feel weird. And if one does not have control of your inner monkey and your emotions, it will always seem like the wrong time to do it, right? But my dad would always tell me, if there is an uncomfortableness with something you're looking to do, provided it's legal, right, that's going to advance you in whatever area it is you wish to excel in, doing that feels most uncomfortable is typically a winning process, right? Or a winning usually basically means that you're looking to do something that frightens you, right? Now, I don't suggest, based upon that really rotten analogy, you jump into the ocean full of waves during a hurricane because it frightens you, right? But just do something that is fearful, that can help you advance in whatever area you're looking to advance. I don't care if it's spirituality, health, fitness, finance, right? Business, interpersonal communications, which I think the vast majority of people on this planet lack the basic skill of interpersonal communications, right? Something we could always work on. But the key thing also with this type of movement is that you have to look way back, right? And you really don't have anything to go on. Yes, if we rally again, this 1.04 area is probably going to serve as a resistance level, and who knows, we could spend the rest of the summer just bouncing underneath this in absence of anything dramatically that takes place from any kind of bank of wherever, right, or the Federal Reserve. So maybe that wasn't the most direction you were looking for, but the problem when you get up into these nosebleed areas is that from the standpoint, we'll jump over to the trading view charts on this, but once you get up into the nosebleed section on a lot of this stuff, or down for that matter on the previous Euro chart, it's really difficult to process any sort of comparisons to the past. Why? Yes, some of the all-time highs or lows will more than likely be areas that any asset trading on a chart, that has a liquid market that's efficiently traded, is going to gun for those highs or lows, right? They're always going to try and in many cases, they'll air gap up into that area and be leaving tons of notches below, which from a market profiler perspective, you want to see those missing notches, because that means if it rips up into a big area or a down into a big area, maybe it hasn't touched in 2 decades in this case, once it comes back, it's going to want to auction around down near that. So it's always a good time to be trading in front of the train. It's one of the very few times I ever talk about in front of the train, because it's a huge mark. It hasn't been touched in a long time. And in a lot of cases, the algos will rip right into it, because very simply, many people are setting their stops there, and the algos want to just go up and clear the queue and then reverse, right? So I always let that play out but instead of stepping in front of the train, I only want to step in front of it once it gets to that big level, right? Because I know that 9 times out of 10 there's going to be a reactionary rip, almost like a bolt of lightning into it, and then it's going to reverse, right? Now, what happens after that is anybody's guess. Typically, it will stay in that area and put some work in building a whatever until it breaks again higher, as we saw in the dollar, or it reverses and goes back down. So, but just taking a look at the dollar right here, I mean, this is a light pullback coming back up towards the top. You can actually see on the daily chart here, maybe not the easiest to see here, but I'll show it to you on TradingView. This is actually a cup with handle breakout. Now, you don't want to be standing in front of something like this. You want to be grabbing the coattails of this trade as it rips out of this level. And as you can see, once it did, maybe not the, a little better if I zoom in here. Once you actually break out of that level, you're clearing the queue. So you can see how it came up to it, and then boom, volume was high, as you could see. And then the algos went out and cleared the queue and just took out all the shorts. This is really just a chart pattern on anything that trades with liquid and is an efficient market. I would never step in front of this try and short it, right? And if this was the all-time high from 20 years ago, I'd much rather be playing up in this 108 area as a reverse to potentially go back down to this level. Because this right now, whether or not a squeeze zone indicator line on my TradingView chart pops up in this area, doesn't matter to me. It is now support. So this 105.61 area. Actually, you know what? Let me get back here. Let's take a look at the whole shebang. So, not going to get too much in the weeds. I've shown this a lot, but dollar lifting, everything else going down. Major land. Note the drop recently only because of the magnitude of the rip up in most bond land, right? I think this has been a surprise to many bond vigilantes out there that we've had just this much of a rip, but yet a few days of a pullback here. And then many of these commodity charts, they're low, you know. I mean, look at gold. Again, we're on a daily chart here. And, you know, if the, actually, let me just go to weekly. Because I think this is significant. You know, obviously we've got solid support down at, this is the spot gold chart. As long as we've got, you know, nothing going on crazy, we've got essentially probably about 60 points to go, price of an ounce, as major support. You know, if the economy was really that bad and we were truly headed into recession, why is gold going down? Right? This is a store of value. And in, I think it was last Saturday, I went on a gold diatribe talking about how you want to stay away from all the crazies in any area, especially in this group, because they'll brainwash you. Let's see. That's pretty much it. Let's jump to TradingView. I don't really want to get too into it. Notice the VIX here falling back. Again, not any levels. You know, if you guys haven't figured out at this point, I'm really trying the last month or two. Trying not to form any feasts because, man, there's just way too many moving parts of stuff going on right now. There's been a whole bunch of uncorrelations that used to be correlated that broke and now they're uncorrelated. So I'm trying to just look at each of these indicators as of its own separate entity, if you will. But yes, it's movements and correlations. You know, there's just been globally a lot of breaks in the credit markets. There's been all kinds of weird spreads that have developed between this and that, and it's really not worth spending too much time in detail on because it flies over everybody's head, including mine sometimes. But just know there's just a lot of disjointed stuff going on globally. I don't care if it's credit, commodity based, certainly in equity land. And it's spilling over into currencies. And very simply, the only thesis that even matters right now is that the dollar strengthening. Everything else, for the most part, is going down in major land. So that is the takeaway from the current environment. It doesn't necessarily help one in that micro trading or the minute time frames that one may trade on. But if you have a broader idea of what's going on from a big macro perspective, it gives you a heck of a lot more confidence to drill down inside that and read that. So this is the break. Again, I talked about a couple of days ago in the dollar, looking at a daily chart now. And we rip higher. The imagined support's probably going to be somewhere in this 105 spot 80 area. So just know that. If you're trading the euro, it's going to be the same thing. This break right here. Just a little lower. Should almost be a squeeze zone line in here, but I'm pretty sure this is going to be resistance here. 1 spot 0360-ish area. I think this particular, it's funny, by the way, I watch a fair amount of classic car shows on Motor Trend, which used to be Velocity Channel, and there's a lot of British car shows, and they do like comparisons in dollar versus pound in the conversions. And some of these car shows are like a few years old, and you're looking at the comparisons. You're like, hey, wait a minute, there's no way that it costs that much more now. It's much more affordable, at least from a dollar perspective. I'm actually not going to get into a lot of these currencies because I think I'm doing you guys an injustice by just breaking down the detail, but I will show a couple of charts of interest, especially this one. So big drop in the euro, right into that squeeze zone area. I'd say like 0.8550-ish area. What else did I want to note? Actually, let's take a look at GBP CAD. See what we want on here. I haven't been paying much attention to how well NEO has been reacting to these movements, but I do get it's not necessarily trading on a daily time frame, but whether one wants to admit it or not, the vast majority of these algos that are written for literally anything that trades in a liquid efficient market, the daily charts, support and resistance lines, and the moving averages there, along with bands of some sort. In this particular case, you're looking at a custom Bollinger Band, but any sort of expansion or risk-based band around it, they're built into all those algos. So they may or may not admit that, but they're built in because they're important areas. So why would you want to build an algo where it's completely ignoring all the higher time frame stuff, which carry a significantly more weight in terms of potential reversal or a containment of a trading sideways, right? All right. So honestly, I don't really know. Maybe I should just make this larger again. I don't really see where we have any edge here. I mean, obviously this low of 1.1530-ish area, right? That's held a bunch. That's probably pretty solid. But the pound's been in the toilet for so long that we would expect a rip just to sort of level up the movements, right? You spend a lot of time riding any kind of band down, especially on a daily chart. You're really just getting extended. This could be the exact same example on an upside move too, right? You're just getting really sold off, continuing to take these rips back up short, you know, the risk is really getting heavy here that there's just going to be a face ripper move out of this area, right? So just know you're getting sort of long in the tooth. The question I get asked most is, you know, where do you enter a short or a long? And when you have just a very, very defined downtrend in this case, and you could draw two parallel lines right here, right? A very sharp downtrend, you know, your best place to get on this is typically the first one or two pullbacks, which essentially is right here and right here, right? Once you get further into this trend, the pullbacks, you know, yes, you could say, especially if you're trading, you know, real short-term stuff, you know, this is a good pullback to get short on. But now we're, you know, arguably 3-4 pullbacks in a daily trend down for, which is what has been almost a half a month, right? At some point, you're running out of 9 lives in trading. I just wouldn't do it at this point, right? You're always best. And then the argument can always be like, well, you know, how do you know this is going to be a trend down all the way? Well, you really don't, but you don't really care. You want that to continue. More than likely, you're not going to be in these trades. You got in short, you rode this down for a whole bunch of pips. You did well, right? You're out, waiting for another potential setup, which may not be anything like I discuss. I only really discuss the types of setups that can apply to any market, any commodity, any currency, any type of, you know, again, liquid efficient markets. That's the key with me. These patterns repeat themselves over and over again. I mean, nothing's new. The key is just understanding the pattern, seeing how many sort of 9 lives, if you will, you're going to get when this pattern continues to show itself. This is called a slingshot, by the way. It's a very popular pattern. It has one of the highest win rates out there in relation to anything that's a downtrend. It has the kind of win rate that the couplet handle has in either a breakout up or a breakdown. They're much more easy to spot in a breakout up, like I showed you before on the dollar chart. And what else? That's it for Neo. Talked a lot about crypto. We're still hanging around the edge here. Daily chart, yes. This has been the first decent attempted rally. Got some support here. Again, if we trade below this area, let's hold on for dear life or we're going to bail. We're going down. Volume's been lower. Yes, it is summer. I get it. Other things to do. But just know that. I was trading the S&P. Let's take a quick look at that. Still think we're up against some pretty decent resistance right here, just under this 4,000 century mark. Every time we've come up against it, it's been an area of resistance that's pushed us back down, and so we have had to continue to build out more of a pattern. I guess you can also argue that we're flagging here, right? But we've had declining volume. Not too much to read into there because very simply, it is vacation week, at least for a chunk of the trading community as U.S. residents here. Let's see, 1, 2, 3, 4, arguably 5 days on the daily chart here. See this perfect doji right here. This was on the 30th of June. This was a while ago, but always gets to show an example of why any type of doji, which is an indecision candle, oftentimes has a counter move in front of it. It's almost like saying, well, we don't think we can go down anymore. That means we got to go back up, right? When, how far, how long, to what degree, the volume, participation, it's anybody's guess. So all you can really do is just say, hey, I've registered doji. don't think I'd really be taking too many shots of going short the next couple of days, especially with an overextended move down, in my opinion, that needs some backing and filling all through this whole area, right? We have incomplete auctions all in this area. May not be necessarily visible on this chart or with the market profile on the left-hand side because this is a very generic chart, but I guess at some point I should switch over to some of my trading systems and you guys can see a significant greater detail on that, showing all kinds of incomplete auctions, which just tells me very simply, if that is in fact the case en masse, that we're going to more than likely go up an auction inside these ranges to do what's called backing and filling, right? There's been some zippers that the market's burst through, like right here. So this is like what you call an open zipper, meaning that it's skipped a whole area. One that may have studied a lot of this could say, well, it skipped the whole area, but there's been plenty of auctioning back and forth. So maybe there's not any missing notches of volume in this. Keep in mind, we're just talking about volume in the aggregate here, market profile based auction market theory stuff. Sounds complex. It really isn't. It's just a different way to look at volume and time versus just looking strictly at price action, right? So you can look at time as a factor of in price action, right? How much do we spend in a particular area in terms of time? And then you would also look at it from a volume, how much is accumulated in that period of time, right? So if you guys are ever bored, there's actually some great books out there. I've shot a gazillion videos on AMT and market profile. You can go to my YouTube channel. You can listen to your heart's content. Probably eventually be sick of hearing my voice, right? But I guess that's all part of the fun. Be a sponge. As far as like tactically, next week, we've just got too many variables for me to guess. My first guess, if you're going to be trading this in any sort of MT based pair or index, I would just say we'd probably be looking to break above this 4,000, put some time into maybe building out more of a complete auction above this area. Right? Remember, when you're looking at these charts of anything, you always want to be saying to yourself, where's max pain in this market, right? You look at this chart of the S&P, which comprises the largest 500 companies by capitalization, not stock weight, like the Dow. That's why it's a piece of shit index. I always tell clients, don't look at the Dow. It's very inefficient. I mean, it is not a measure of what's going on in equity price land in the U.S., but the S&P 500 is. So the broader the index, the better subset you have. I prefer, from a very macro perspective, the Wilshire 5000, which includes small, mid, and large cap companies as a whole. Right, it tells a different story than what the S&P does. Both are not in a good health grade right now. Both of them basically have COVID, right? But if I had, gun to my head, had best guess, I'd say we'd probably go up a little closer to 4,000, try and burst above this. This is max. Actually, max pain's right in here. If you could see this whole zone, this is max pain, because the shorts would be coming in and resetting up right here, right? Looking for another potential, very late to the game, by the way, slingshot back down. Doesn't mean it can't work. Just means that you're taking a shot late in the game, right? What else do I want to address? Yeah, I think that's pretty much everything I wanted to talk about. I know that so let me cover that on Tuesday. We're getting a little late in this broadcast here, so And everybody generally has better things to do than sit around and listen to me drone on about a lot of this stuff. But I think it's important to always be able to take nuggets away from any presentations. So hopefully I have offered that for you. With that being said, Steve Vetterl off the mic. Have a great weekend.